And season's greetings from Birmingham, England, home of Sensible Investing TV, the independent voice of asset class investing. Let's have a quick look back at 2012. Who were this year's winners and losers? Well, as for the losers, mutual funds in the North American equity sector hardly covered themselves in glory. In the 12 months to 1st of October, not a single actively managed fund was able to beat the S&P 500 index over the same period. But the year's biggest losers, once again, were hedge funds. For the fourth consecutive year, the majority of hedge funds have underperformed every major stock and bond index. And that's despite the supposed elite of the investing world charging around 2% on their funds. Doesn't sound much, but over time that'll take a massive chunk out of any profits you make. So commiserations to those hedge fund managers. Better luck next year, guys. What about the winners in 2012? For us, there were two standout performers. Out of 191 funds in the global equities sector, the very top performing fund over 12 months to 1st of October was a humble index fund, the L&G Global Index Fund. And then there's the index fund specialist Vanguard Asset Management. What a year they've had. The $130 billion in deposits that Vanguard took in November is an industry record and further proof that investors are turning their backs on overpriced and underperforming actively managed funds. Of course, some active fund managers have succeeded in bucking the trend. We acknowledge there are some clever managers out there. But let's not underestimate the part played by luck in producing superior returns.
You know, if you think about coin flicking, if you start off with a universe of 10,000 managers and you flick heads or tails, the next time round it's 5,000, 2,500, 1,250. And those managers will be deemed to be star managers when all you're getting is coin flicking noise. And so within a big universe of funds, there's always going to be some lucky coin flickers, and trying to discern true skill from the noise is a really challenging prospect for any investor.
So what about 2013? Well, the financial pages and business channels once again are full of share tips and market predictions for the year ahead. For us, that's all just more noise, speculation, and frankly, there are better things to be doing at Christmas time than worrying about markets going up and down.
I don't think there's really any value in these short-term predictions, and I understand that it sells newspapers and magazines, and it attracts people to watch, you know, the financial media. We're all interested in these kinds of things. It's kind of like believing in Santa Claus. You know, you want to believe that there's a way to beat the market and someone can actually forecast these things, but I think the preponderance of the evidence is that it's not useful.
Of course, here in Europe, the financial media is still very focused on the euro. Is there an end in sight to the Eurozone crisis at last, or will the single currency still collapse? In America, it's the fiscal cliff that everyone's talking about. The fact is that if you have a diversified portfolio and you're investing as you should be for the long term, you really don't have anything to worry about. So, happy Christmas. Thank you for watching in 2012. See you again next year.